Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade, episode number 127 for May 26, 2020. My name is David Kosmider. I'm the creator of TimingResearch.com, and today we will be analyzing your trade ideas. So I thought this would be a good time to have a special episode where we just have Jim, the option professor, on to talk about his thoughts about the market and then analyze the list of symbols for today. So Jim is sharing his screen right now, and I'm going to go ahead and turn it over to him.
Okay, thanks, David. And again, welcome everybody. This is Jim with OptionProfessor.com. I provide content for OptionProfessor.com, and just a quick background on myself for some of you who have not attended these before. I'm a graduate of Boston College, and I've been in the investment arena for decades, and I'm very, shall we say, knowledgeable about all different types of investments. And so I'll be talking today a little bit about the stocks that you've put down, and I'll be looking at them on a technical basis and giving you some opinions and some observations that I might have on whatever you guys have written down here. And again, at the end of the broadcast, we do have a weekly market update that is available, and you can get that free of charge initially by going to the email address that I'll talk about at the end of the broadcast, and then you'll be in the queue to receive the weekly update on the markets. Okay, so let's get into it here. Let's start with an overview, because we had a big day today. There's no doubt about it, but I would call it the have-not day, meaning the tech sector and things like that did not really have big days, NASDAQ, but we had a big catch-up trade in things like the transportation average and the banks. So that would be the trifecta for the day as far as I could see. And we were up, we were hardly up at all on NASDAQ, but we were up 4% or better on the transports, 3% or better on the small caps IWM. And we were also up, some of those banking stocks were up as much as almost 10% today. Again, the big thought on the banks were that the spreads, because interest rates are low, were going to be very tight for them. So their profitability was going to go out the window. Again, there is good reason to believe that the duration, the long-term interest rates are possibly even going to go higher because, the loan rate, the mortgage rate is at 3.5 and change. That's not that far off where it was, pre-dip. So that's pretty good rate out there. And of course, they don't have to pay any money in the money market. If you don't know that, go down to your bank and ask them what your money markets are paying, and you'll find out it's pretty lousy. So there is a spread there for them to make money on, and they're in great financial shape as far as their reserves are concerned. So there was a good reason why the banks had a good rally today, and that may be the surprise of 2020, is how far the banks come back and how big they come back. So keep an eye on that. I personally, my opinion, they definitely, in my view, have hit their bottoms, and you're not going to be able to get JP Morgan at 80 anymore, and you're going to be in the hundreds before you know it, and you're not going to get these other stocks at that discounted price. And I think there's a lot of runway to come because one day does not make a trend. So it could bounce around a little bit, but I think that the surprise this year is A, that the longer term rates may be higher, so the spread for these people to make money. Plus we had deregulation, for you guys are wondering. Deregulation means that the bank can do a whole lot more with their money than they were before deregulation. And so, and again, the Fed is being very liberal and the Treasury very liberal with certain things. So it's a good situation possibly for the banks, and people are going to be very surprised possibly how well they do. It's not going to surprise me because I thought they were very good a month ago. All right. So that's the S&P in front of you. And what I'm going to be doing on your stock picks here is I'm going to be showing you the longer term picture. And then you can possibly try to figure out how you want to trade off the shorter term picture. In other words, this is the S&P going back 20 years. And as you can see, we've got a situation there where it gives you a red line, a green line, and a blue line, and those are called moving averages. And as you can see, as I've been telling people, This looks like 2016 and 2018 right now. Okay, so that's the way I've been talking. This is 2016 and 2018, where you have breaches of the moving average and then right back on the bicycle. A breach of the moving average and right back on the bicycle. And that input has been very accurate and has been very helpful to people, because people who think they're going to get a second bite at this apple right now obviously are sorely mistaken. And once we got above 2790, which was the 50% jump from from the drop of top to the bottom, 50% was 2790. Correspondingly, that's where the 3-year moving average was. And ergo, as soon as you broke that, that was your buy signal. If you want to be safe and try to buy it with the moving averages at your back, which most people like to do if they're trying to hold on to something. Now, so can you see the point? This is why I brought it to people's attention. That is what happened here. That is what happened here. And these guys who want to get reelected in November, right? They know they can't have this thing looking like this over in '08 and this in '01 and get reelected. Mnuchin and Trump and all the administration, they can't get reelected if we're in the soup, right? So what did they do? Including the Federal Reserve guy. They put so much money into the system, it's a joke. And they set up a lot of programs to just print money and hand it out, because they needed these markets to get back above that blue line and resume an uptrend if they think they're going to have any chance in November. Because again, this was something, that does not really build confidence. And so if these moving averages crossed, it takes years to come back above it. It takes years to come back above it. They don't have years. November's 6 months away, 5 months away, 4 months away, whatever, And so the bottom line is that's the way I've been talking to people about how my opinion is on how to play it. And it's been very, very good. Okay, so there you go. Now you got a macro picture, and you don't want this thing under 2,800. So if you're bullish, you can buy every dip as far as I'm concerned, but get the heck out of there if it breaks 2,800. Because if it breaks 2,800, and people are saying, I'd like to buy it at 2,600. Can you see how silly that looks? I'd like to buy it at 2,400. I want to buy it on a dip. Hey, listen, these moving averages cross over because you're trading down here for a few months. It's going to look like this in '08. It's going to look like this. And I don't think you want to just hold something for years and hoping it goes back up. So that's why your line in the sand, in my view, is 2790. And you're obviously at a big day today. That doesn't mean it's not going to have pullbacks. But again, if it's going to, people are saying it might go to 3,200, 3,400, 4,000 over the next few years. Well, as long as it's above that blue line, that may not be crazy talk. Okay. Then the other thing, before we get into your stocks very quickly, is, how are they going to get the earnings to come back up to make these things justified? Well, use your common sense now. If 40 million people are unemployed and they're not all going to get asked back, and they're getting paid so much on unemployment, some of them are not going to come back. In fact, they're talking about giving cash incentives if you go back to your work. I just saw that on the wire. So anyway, the bottom line is if they don't bring everybody back, that is your employment costs going out the window. And then if you are working remotely or with less people, there goes your real estate expense out the window. Those are two enormous expenses for business. So just like in '08, when we had a recovery, earnings came back to peak earnings very fast on less revenue because expenditures were slashed dramatically. And I contend that we're going to see a repeat of that this time. So if you're wondering how you get your earnings back up, if you have less expensive but less revenue, you can still make out okay. All right. So that's how I see it, and that's how I've been seeing it, and it's been a very good view. Okay, so that's the story as far as the overall market is concerned. Now let's start going into some of the stuff that you guys have put down here. Okay, Microsoft. I'll tell you my feeling on Microsoft. Obviously, a great company. I mean, bad-mouthing Microsoft is like bad-mouthing Santa Claus. It just keeps delivering presents all the time, right? But every dog has its day, and every dog sometimes gets to a point where it's extended, and that's what I've been telling people here. So here you go. My view, my opinion. Let's bring the chart into focus here so you can see it. Okay, you can see this thing obviously over the years just flat, 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 and then it goes nuts. Okay, now this company's got the iCloud thing down, and they've got a team going, which is going to be like Zoom, and so they're all over it, right? And they're working with hospitals now to work with remote or teledocta. So they're going after teledoc a little bit with the iCloud. They're going after Zoom with the team. And so, they're just a great company. But in the short run here, it's gone to 190, right? And today, I think it was rolling over a bit. I've been suggesting people consider. I mean, look how far it is from their moving averages. That's pretty far. So why not consider writing some calls, right? And consider writing the calls, it's 200 or 210, whatever you want to choose. And then either just sitting on the stock and having the call up there and just using that cash, for whatever you want. You're agreeing to sell the stock at the strike, right? So if it goes up there, what you could do is buy back the call, right? And negate the contract while your underlying stock is rising and get a plus or minus out of it, depending on how much time went by. Another strategy would be to sell the out of the money call, take the premium, and buy a put underneath. So if the thing is going to come down and test this area for whatever reason, who knows? Maybe China and Trump get into some kind of a match, right? Or maybe these people don't come back to work because they're getting paid so much on unemployment, and that goofs up the market some way. But retaliations and stuff like that, things can change, especially in the short run. So if it did, selling the call up here and then buying a put would give you parameters on your stock, meaning your 100, let's say you have 1,000 shares, your 180 grand would have a cap on it at 200 or 210, whatever you sell. And then if you bought the 170 puts, it would have a cap at 170 grand. So at least your 180 grand could go up to as much as 200 grand or 210, whatever you pick. And it has a floor underneath it at 170 grand if you bought that put for the time that those puts and calls are active. Okay, so these are some things that I would be pricing out if I was in Microsoft, because I'd be concerned because it's so extended here. And while we know the news is great and it's a great company, again, some things can happen to cause dips. Okay, so bottom line is that was the low of the drop, 130. I don't think you're going to get that low. But could you get into the 160, 155 area with some news that could not be positive? It's possible. And that's why you'd want to protect your equity up here at the 190 level. Okay. But clearly it's in an uptrend. Clearly it's bullish. Clearly it's it's a fabulous company. And clearly if you just hold on to it and ride the waves up and down, I think on the longer term, obviously you're looking at a company that could be much higher next year. So in my view, it would either be a hold or a hedge. Okay, I don't know that I'd initiate positions up here at 190 area. If it broke 190, I might change my tune on it. But right now, 190 seems like a good line in the sand. And then again, here's your 1-year moving average is 154, and your 2-year moving average is 132, and your 3-year moving average is 116. Okay, obviously trying to buy it closer to the red line and the green line, to me, is better. Okay. And if you don't own any, you want a dollar cost average, you take a little bite up here, you see if you can get it down near the red line, you buy a little bit more, get lucky, get down near the green line, probably not, but at least maybe you could get it somewhere closer to the red line. Okay, next one up is going to be Apple. Apple's opening a lot more of their stores, but the question on Apple would be, are people going to have the bucks and interest to buy the more expensive phone they're coming out with? And, is it going to be a situation where, we're not going to get the revenues out of the services that people thought, and, things along those lines. And, of course, their supply chains, Foxconn and other companies. Let's try to cue this up. Could also be problematic. Now, again, this is a ditto on Microsoft. Great company, unbelievable balance sheet, cash up the gazoo, fabulous product, but it's also way up here, very close to its high point. Now, it may have one more burst to the upside, okay? But again, it's a little bit extended for my taste, okay? And so, again, the 5G thing is supposed to be a big, powerful moneymaker for them, but their services was the one that lagged last time that they announced, and ergo, that could be a cautionary flag. So what would I be interested here? Great company. If you want to hold, fine. If you want to see if you can get a dip down and buy some, there's your moving average there at 260 ballpark on the 1 year, 224 and 204.91 is your, call it 205 on your 3 year. Okay, it got all the way down to the green line, so that was a great time to buy, right? So right now, because the market is turning and there's a lot of bullishness, maybe your best bet might be trying to get it somewhere near the red line, which is 260. Could it go down there? Again, it's going to need some news to make it go down there, but who's to say it won't get it? So again, it would be a hold or possibly a option writing, where you look at your 340 calls and see what they're going for, maybe your 360 calls, see what they're going for, take that premium, just sit on it, gives you a little bit of downside hedge, get some cash flow off of it, or take the premium, buy your puts at 300. Say you have 1,000 shares to make the math easy. Your $316,000 would have upside potential to 340 or 360 grand if you sold the calls. And then if you bought the puts at 300, at least you've got a floor at 300,000 on your position if the market rolls over on you until these options expire. You can also adjust these positions, meaning if it goes up and you want to buy back the call and roll it up, meaning you buy back a 340 call and maybe you sell a 380. Now you're still in the stock. These are adjustments that can be made. Obviously, from week to week, we do come out with some information on how the options work. We try to show you the use and the risk of the strategy, and then you can consult your broker, your advisor, your clearing firm, brokerage firm, to find out what, if anything, might be suitable in the area of the options. But those would be the things right now that I'd be looking at on Apple: a hold or do some hedging. Okay, next one up is Zoom. I've been a believer that Zoom's going to have a lot of competition, and that spike up number may hold up for a while. Let's see what it looks like. Obviously, these guys went nuts. Everybody started using their product when we went into lockdown. And so, Zoom was a great company to be in and ride the wave. It hadn't been around that long, okay? So, but you got competition coming in from Facebook, you got it coming in from Google, and you got it coming in from Microsoft. That sounds like a lot of competition, and that sounds like companies that could really, put you in a pinch. So it ran up to 180, and now it's in the 164 area. If you see, after it hit 180, came back down here. Now it went back up. Now it's around 164. Again, it hasn't been around that long, so you got a 1 year moving average only. It comes in here at about 100. So basically, I would be a hold or I would be a hedge. A lot of the tech is going to be, in my view right now, a hedge or a hold, depending upon, how you feel about it. So great company, a lot of competition coming in, still in an uptrend. So if you want to hold on to it, who could blame you? But on the other hand, it's a bit extended. Let's see. AMD. Again, part of the tech sector. If you notice, again, tech is not moving. It may be stable, okay, but it's not moving as much as it was because there's been a rotation into, the catch-up trades, your transport, your banks, travel and leisure, that kind of stuff. All right, so this one here is, again, pretty high up there at the 53 area. And you can see, again, 60's been some trouble. And you can see 40 is the 1 year. 38 is the 1 year. 30 is the 2 year. And look where the 3 year is, way down here at 25. So again, good company. You want to hold on to it, no problem. Just be ready for a little bouncing. And then basically, if you think it may have run out of steam here at 60 temporarily, then it would be a candidate for the hedging, the selling of the calls, and buying puts with the revenues. Yeah, again, because it's had a very, very huge run. And obviously, you know, there's a reason for that, but there's also a reason why this high was made in February, and we have gone through, or excuse me, made in February. And of course, then we had the big drop, and then we've come back up, but we still haven't taken out the February highs, but it certainly has been tested. Again, you know, if you're in the stock and you want to hold it, you know, you can't argue with that, but you can say that this isn't as bit extended, and it would be vulnerable to any news that would not be positive. And since, you know, the supply chains or origins of China and our country seem to be having quite a back and forth, and we got the Hong Kong thing going as well to complicate matters. This might be a situation where if you're going to get a correction, my guess would be it's going to be coming out of what? Trump fighting with China. And then the supply chains and all the rest of the back and forth with tech would, you know, maybe have a reason to come back down. So as far as tech is concerned, my view is if you want to hold it, fine, if that's your cup of tea. But if you wanted to hedge it, I certainly wouldn't argue that this is a terrible time to consider that. Okay, next one is Boeing. Yeah, Boeing's been a wild one. Let's take a look. Okay, with Boeing, obviously you guys know that they had problem with their planes, right? And they've got parking lots full of planes that need to be sold, and they have got financial issues. But one person did say that when Boeing came out in their condition and raised $25 billion in an offering, that was the sign that the lows of our stock market were in. Because if anyone is buying Boeing bonds during this kind of environment, they must have a pretty good idea that we're going to snap out of this downdraft. And of course, that certainly was an accurate thing. So you've seen it drop. It was up at 440 and a nice uptrend for many, many years. Let's just make sure you can see the years so you can see how far this has gone. When it's gone so high, it went off the chart here. So you can see from, you know, it used to be in the 2000s, it was trading between, you know, cost adjusted 20 and 100. Then it started trading 100 to 140, and then it went nuts to the upside. Again, it's a duopoly with Airbus, so that's a pretty good deal. Now, you see these moving averages? When you get way away from them, the market tends to come back to them. It's called a reversion to the mean. Obviously, when you get down here, the reversion to the mean is way up here, and that could be a rough racket unless we get air travel changing dramatically, or we get these countries borrowing money or printing money, whatever they're doing, and getting the money out there to buy planes. And if that's the case, it might help GE as well. Anyway, how would I play a Boeing? Well, let me tell you where the moving averages are. We're up at 315, 327, and 292. So let's say best case scenario is you're around $300 on these things, right? Right around 300. That's about the low. Yeah, with regards to longer term, it may very well matriculate it way back up there. So if you're a long-term holder, I wouldn't have trouble with Boeing here, and what do you call it? And getting out if we break 80, because there was a good reason why I stopped at 80. If you look at 80, that's you know, somewhere near these lows and these highs, so in that ballpark, right? You don't want 80 getting taken out. Right now you're at 144. You know, another thing you can do down here is sell puts. Why would you sell puts? Because when you sell a put, you're agreeing to buy stock. Well, since the stock used to be 460 and it went down to about 100, maybe this is a better, unless the company's going out of business, which is a possibility, but probably not a probability. Then you sell puts down here. So I'll give you, for instance, on this. Say you want to, the market's at 140, and you don't want to buy the bounce back up. So you look at the puts at, well, let me give you some concrete examples here. We'll look at Boeing. And let's say between now and the end of the year, you're anticipating a recovery in Boeing. So you go to the December contracts and you say, I am willing to sell a put option on Boeing at $100 because I'm willing to buy Boeing for $100 between now and let's say Christmas time, sometime in December. Let's see if I have something I can show here. Here we go. Okay, so between now and the end of the year, whenever the December goes off the board, the ones I'm trying to look at here go off on the 18th. The 100 puts are going for about 16 bucks. Okay, where there's a theoretical example, hypothetical example, let's use the word 15 bucks to make the math easy for me. Huh? Okay, so you're going to sell a put on Boeing in this example, and you're going to sell it at 100, and you're going to sell it at 100, and you're going to get paid $15. So what's going to happen? One of three things could happen. Many things could happen beyond it, but let's talk about three things. If the stock rises from 144 and the time runs out, you keep 1,500 bucks on every contract because every contract's 100 shares. So you keep 1,500 bucks if it goes up. If it goes sideways between 120 and 160, 160, 120, and 180, time runs out. Again, option goes to zero, you keep the 1,500 bucks. Okay? If it goes down and they put stock to you, meaning they say you have to buy the stock, that's what you're contracted to do. Sell put, buy stock, right? So you have to buy 100 shares. What's 100 times 100? That's 10 grand. So you've agreed to buy 10 grand worth of stock, and you got to put that money up if they go down to 100 and put stock to you. Okay, so those are three possible outcomes among many. Now, maybe you say, well, the low was 80 about. How about if I sold a put at 80? Well, if you got to the end of the year and you sell a put at 80, you get about 9 bucks. What does that mean? That means if Boeing doesn't go down to 80, stays above, goes 100 like it is now, boom, time goes by, you make the 900 bucks. If the stock goes sideways, 100, 140, 90, 140, stays away from 80, again, time runs out, you get the 900 bucks. If it goes down from 144 to 80 and they put stock to you, that means you've agreed to buy the stock at 80 minus the 9 bucks you receive. So you're in there at 71 bucks. 71 bucks is a historically fairly low level. It would take you back to where the stock was back in around the 2012 to anywhere between 2010 and 2013. Okay, so that's, if you were asking me, what do you think about Boeing? I would say Boeing is very, very oversold, and it's very, very problematic. I would say that Boeing's turnaround is going to take longer than less time. So if you're patient and you want to pick it up down here and hold on to it, it might not be a bad thing. But selling puts down here to buy it at a discount might not be a bad thing. And one other thing you can do is you can take that premium you received on selling the puts and you can buy calls with it. So say you sold that put we talked about at 100 for 15, and then you bought the 180 calls for 15, and the stock goes back to 260 by the end of the year. Who knows? Then you have the right to buy at 180 minus the 260. You'd make 80 points on it. 80 times 100 shares would be 8 grand. And the cost of buying it was coming from the put you sold at 100. So, not a bad strategy to look around and think about on something like that, as long as you're willing to buy the stock and take the risk of where you're selling the put at. All right. Next one is GLD. This one I've been thinking may have summer where it takes the vacation this summer. I'm not sure. Okay, on GLD, let's take a look at the chart. Now, I've been very positive. We've been very positive on gold. So once you break above 130, it's time to be long the gold, right? And obviously stay long the gold because it never really turned down. You had a little test there. That'd be a great time to add to the gold, right? Now it's way up here, and it seems to be having trouble getting above 170, and it's a bit extended. So if it gets above 170, maybe it's going to have a parabolic move up because the dollar goes bad, because inflation comes back, which I think it probably will. You know, oil companies are trying to raise prices already because they've closed all the rigs down. Not all the rigs, a lot of the rigs, and the frackers are closing their operations. And Saudi and Russia have come to some idea that flooding the market with oil is not a genius idea after all. And people are coming out of their cocoons and they want to drive. So you got demand looking like a V, you got supplies looking like an L. And our position has been that the oil prices will be between 25 and 40 this year, and maybe 40 and 55 next year, depending upon how things shake out. But certainly the days of $10 oil should be well behind us. That's the view currently. Okay, so gold, what would I do up here? It's kind of like tech. I would either probably hedge the situation, hold it if I owned it, and particularly if you owned it from lower levels. And I would hope that maybe in the summer, we could get some kind of a backing and filling. And then where's your moving averages on GLD? 144, 131, and 128. Hey, it's a bull market, technically. I'm not arguing or debating that. And they've printed more money than paper. You know what I mean? I mean, how much money is being printed? It's a joke, right? But the dollars remain firm because based on other currencies that are a joke, we're got a less of a joke going on, meaning the yen and the euro, they're printing money and they have no growth at all. And so they're going nuts. And of course, even developing countries are printing money. So the people are, you know, obviously nervous about paper currency. And so that's why the gold makes a lot of sense. But, you know, when they start paying $150 over spot to buy a gold coin, that's an indication of froth, right? They're not paying 150 over spot at the bottom, right? So that's my concern. The froth is there with investors. They're hoarding. They don't hoard things at the bottom. They hoard things when the prices are high. Now, again, because we have a situation going here, we could have a parabolic move. You get above 1900 on spot gold and it could fly. You don't know where it would go. So, you know, I'm not debating that as a potential possibility. But from what we know and what this thing looks like now, you would have to say it's extended. And you would have to say it's had a very nice size move. And you'd have to say that the dollar has been fairly stable. And while inflation may come back, it hasn't come back yet. So having said all that, you know, that's my feeling on the gold. Silver, you know, people are involved in silver. You know, it's the same story except for one thing. Silver, if it gets above 19 or 21, has a lot of potential. And if it comes back that the economy is picking up, I think it'll really go, because one of the reasons silver has been such a poor performer is it's linked to the industrial sector. And ergo, the industrial sector looked pretty lousy 60 days ago. Ergo, the silver got whacked, right? So silver above $16 is where the support is. So you don't want to have a 15 handle on silver anymore, that's for sure. And if it can breach that 19 or 21 mark, you could see some pretty good activity. In fact, let me put that up so you can see it. And of course, the silver to gold ratio is huge. Let's get it up here. Silver July. And this will go back 20 years too. Okay, so you can see here, you know, that if this thing can clear 20, well, I guess 20 really, but a 19 to 21 is my zone. If you get above 19 or 21, that means all these lines will be underneath the market. And look at all this stuff up here. You see all this area up here? I don't know. Things could get hairy or something. Boom. So clearly, keep an eye on this thing because it does have the potential to go when it goes, as you can see. And, you know, I'm not saying you're going to see 50 again, but could this thing go to 25 and 30, you know, under the right circumstances? You know, it wouldn't surprise me. And you've got mining shares out there to consider, like SIL or the juniors, SILJ. On the gold, you've got gold mining shares, GDX, and you've got gold juniors. Let me give you an idea on what some of those look like. I mean, they've been good, I mean, we've been very positive on the gold shares, no doubt about it, since this thing was way down at much lower levels. And it's lagged. You see how it's lagged? Gold is somewhere near its high, like back here. And look how far it's lagged this stuff. So, but look, it's extended. It's extended. And I don't like to buy extended stuff. Because when you buy extended stuff, the only thing that bails you out is parabolic. And if you don't get parabolic, what do you get? You see here, if you don't get parabolic, you get a pullback, you know? So the bottom line is right now it's really parabolic or pullback as far as these mining shares are concerned. You can't debate they're in an uptrend, and you can't debate that there's reasons for them to be in an uptrend, but you can debate that it's still possible to get some kind of a pullback. So it's a hold. So hold or a hedge. Now, if you break above this level here, you see all this white? I mean, I don't know that it's not going to go up there. This is where it was last time we were there. So there's potential on the upside. This thing has lagged. This has not, the gold shares have not gone up like the metal itself. So somebody's wrong here, either the metal, has gotten ahead of itself, or the mining shares have got to play a mean game of catch up, and we're going to find out pretty soon. Let me just show you what the miners look like on both metals, because if you're out there looking at metals, these might be of interest to you. These are the junior miners, meaning smaller ones that could get bought out by the bigger miners, and that, that makes them exciting. It also makes them a lot more volatile. So let's take a look at these things, because these things have also been on the bicycle a little bit too. Okay. Oh, it's feast or famine here. Here you go. So you can see these things, they got whacked here, during the crash, when we had the big crash in March, right? But then obviously another sign that we're going to get a recovery, because these things definitely believe it, and we're back on the bicycle. Not that really extended from the stuff, right? And if you get above 50, there's nothing holding it back. So you keep an eye on the juniors as well. And let's look at silver, SIL. These are silver shares. And there's many of them. I'm just showing this one here, so I'm familiar with it. Okay, and some of you might be as well. Okay, so there you can see this thing's trying to take out as well. Now, again, it's pulling, it's not that far away from its averages. Where are the moving averages right now? This thing is trading at 34, ballpark, and you're 29, 27, and 29. So that's not that bad. And again, if you get above the area here, plenty of white room up here. So if we get a pullback and it holds, this might be something to keep an eye on. And let's look at the juniors, because they were having a hard time getting above 10. And then the next thing I knew, they were way above 10. Let's see how they're doing now. These are the juniors, smaller companies, smaller mining. Yeah, they're still holding 10, but it's pulling back towards 10. I think 10 is kind of a interesting, 9 would be the number, I guess. So there you go. It's above there. If you get above this number here, a lot of white area to fill out, right? And again, so above 12 would be kind of get on board probably. And then on the pullback, you'd like it to definitely hold this 9, 10 area on any pullback. So keep an eye on the miners, as well as if you're interested in the gold, obviously the miners might be of interest to you as well. Okay, Salesforce. A guy named Ed Hyman used to like this one. Pretty well-respected guy. I wouldn't know what his exact position is now, but I've heard him talk fondly of it in the last couple of years. Of course, this company will do better when people are working. So again, that's why it had a drop down here to 120, but look at it at 176. This thing's not too bad. The 1-year average, 160. 155 is the 2-year. So, this is the neighborhood where it would probably hold. I don't think you're going to go down here if it's any good. So bottom line is you got some parameter here, 155, 160, and you're trading 176, and it's an earshot away from making a new high. So would it surprise me if it blew out 190 and kept going? It would not surprise me. So Salesforce, again, got whacked because obviously the big crash, and also had some trouble. But now it does look like it has made its turn. So keep an eye on it, and I would be positive on Salesforce. And again, you know, it's a company that's been growing and growing and growing and growing and growing. So obviously whatever they're doing is working. Let's talk PAYC. And this is Paycom. And of course, this has to do obviously with nobody touching cash and doing everything electronically and things like that. And of course, that still pays. Now they can also see that the consumer over the weekend was out fooling around, going places and spending some money. And that, of course, is probably very good for the payment processors and payment software and things like this. So this baby here, obviously it was growing. It doesn't have a long history to it, really. It does have a 1 and 2 and 3 year moving average. So anyway, the averages come in at 252, 202, and 164. We're trading what? 280. So again, it's obviously very well extended over the 3 year, but you wouldn't expect to get another bite at the apple if it's any good way down here. So, you know, does it look like it wants to make a run at 340? It does. And what about the short-term average 252? That's not too far away from 280. Obviously, you know, it had a big day today, so it would have been a good thing to get into last week before it jumps above the red line. But again, you know, if things turn sour on the economy, if this restart goes badly, then it could even go back towards 200. So there's some risk to it here. I would probably look at a buy right on this, where you buy the stock and sell a call. At least then you'd have some downside protection and some upside potential. And I'm sure with this kind of volatility going from 160 to 280, the calls have got to be pretty fat. So what I would do here is I'd probably look to buy the stock and sell a call against it and keep the premium. Or if I just wanted to parameter myself, I'd sell the call out of the money and then I'd buy the put underneath. But yeah, this might be a good buy right because of the fact that the premiums are pretty big and you may want to have some protection in case things, you know, pull back a little bit. Again, a China-US skirmish or something like that. But right now, the payment processors have been doing pretty darn good, and this is being dragged up by it as well. And again, today up 4% tells you that it's still part of the catch-up trade. You see, the ones that are very, very extended, they're having a hard time going up as much anymore because a lot of people are already in. These ones here, the sellers are gone, and now the buyers are coming in. And that's pretty much what's going on in the markets, right? The sellers are gone, have been gone out of tech and semis and healthcare for a while. So the buyers have controlled that market and have bid them up. But they bid them up to a point now where they're, you know, the buyer, anybody wanted to buy those things have bought it in the short run. So where's the money going? The money's going into the ones that are playing catch up, where they have not, they're underrepresented in portfolios. So people are what? They're buying those to try to, you know, balance out their portfolios and not have it just be all tech. And now they can see they're back above their moving averages. So these people are more confident that there's a tailwind because the moving averages are under the price and rising, which is comforting if you own something. If you find yourself like in Boeing, where all the moving averages are at 300 and you're holding on to something that goes down $50 a day, and you're wondering why, well, it's because the trend's down and people are getting out. Okay, so yeah, that's the story on old PAYC. Turning to Square, another payment processor. Let's see how that's been doing. I think it had a big kick to the upside. See, people are concerned on Square because, you know, they deal, I think, with a different market dynamic than the big banks, right? So they thought the group that they're serving in the banking area were more prone to defaulting and running away on their debts and stiffing losses. And so that made everyone get out of the stock. And let's see, how low did it get? Hold on here. Yeah, this thing collapsed. Well, it collapsed because they think their customers are all welches and they're going to welch on their debts and not pay them. And obviously going to cause these people to lose an awful lot of money. That's why the stock goes from 85 to 30. Now, as you can see, people are at the beaches. They're going out to, They're going out to restaurants. They're talking about bringing the sports back. So, we're getting closer to going back to normal or whatever normal is going to be. We're not getting further away. And ergo, that's why people came right back into this thing. And that's why it's been a home run, because people who bet down here that the world's not coming to an end and not everybody's going to welch on their loans, and that the Fed's going to help these companies, they were right. And they got paid by taking the risk when it was down. Now, when it's up here, it's again a little bit extended over its moving average. Okay. So this one, again, I would probably think would be a good buy right. Why? Because you're going to buy the stock at $80, and I'm sure the 90 calls should be very fat with the volatility, right? So 90 or 100, $20 out of the money, and get paid a premium on a shorter term deal, might not be a terrible place to be. And then, of course, if you have to buy back the option and roll it up, that's a possibility you can do as well if that becomes a problem. And so that would be interesting to me, because I haven't looked them up, but if I did investigate them and I thought that the options were fat, I would say that this thing's had a pretty good rally, so it could have a pause to refresh, and also that I want to be long the stock because it is in an uptrend and it is a company that seems to be bouncing back with the economy. So if you're in it, I'd be a holder. If I'm not in it, I'd probably consider a buy right, and or a buy right and buy a put and parameter the thing. But it's again, it looks like it's going pretty good for Square right now. Okay, next one is Nvidia. This is another one I'm sure, without even looking at the chart, that I would probably put into the hold or hedge business. But let's see what's going on. They had a decent earnings report, but again, the thing's been bid up. Yeah, it's down 12. Yeah. I talked to people about this, the other day, because it went away up to 360, and they asked me, "What do you think of? What's your opinion on Nvidia?" I go, "I think it's a great company." Well, what about the stock? I think it's way overbought, and you're going to get whacked on it if you don't watch yourself, because it's way up here. The moving averages are where? The 1 year's down at 210, 211, and 203. The thing is trading at 360 or 370 almost, right? Now it's at 348. So, maybe this is going to be, like I tell you, when you get like this, it's either parabolic or, or a top temporarily. I mean, this is a great company. Boom, obviously, right? But again, we get into a big skirmish over in China and stuff. You don't know what's going to happen. So again, you sell the out of the money call, you take in the premium, you buy a put underneath. Now you got an upside potential and you got a downside floor. Not a bad place to be, and if you've been in there that long. Or, since if you've been in it since 200, you got $160 a gain. Why not take $10 and buy yourself a put or something just in case? So, I'd either be doing some hedging or holding. That's about it. And if I was holding, it would only because I think this company is such the golden goose company that, it can handle this kind of extension. But, the chart speaks for itself. It's very extended. Okay. Oh yeah. Semis again. Yeah. A lot of guys are asking about the tech and the semis because you probably made some dough on them and you're probably, let's see what's going on here. Semiconductors, SMH. Okay. Again, you're probably wondering, is it going to continue or not? And from the charts I see, that looks pretty extended, and doing some hedging or trimming or whatever you want to call it, doesn't look like a terrible idea. Now, this one, the semis were up again, but, they're not far from the 150 mark, and that's where the top came in. And, you can see it's uptrending, so it looks great. Everything's great, right? Except for the fact that 150 is still in case. But again, this thing is not that extended from the moving averages. I mean, it's certainly less than AMD was, right? And Nvidia. So at least with the broad-based semis, you get diversification and you can diversify your risk as well. So again, much more of a muted chart than the others. So if I had to do semis, I would definitely not run into the ones that were terribly extended. Now, right now, you're at 127 ballpark, 114 and 108. So you're not that far away from the red line on the 139. But again, it's a little bit extended. And so again, it's a hold or maybe some type of hedging if you thought that 150 is going to hold up for a while. And you thought that we're going to get escalation with China, because that probably wouldn't be great news for this sector. Okay,
Hey,
3M.
hey, Jim. There's some questions from the live audience, or some symbols. Um,
Okay, yeah, you got
how about
some
FTNT?
FTNT.
NT.
So that would be Fortinet. Okay,
Yeah.
let's see what that looks like. Yeah, it rolled over a bit, so I would imagine it's tech. There you go. Okay. Like I say, I mean, am I gonna say something bad about a company that goes from 70 to 150? Of course not. But if somebody says, "What would you do? What's your opinion? What's your experience tell you?" And my experience tells me that unless it's going to be parabolic, you want to start protecting 137 bucks because, in my view, the net, on the Flying Bandini brothers here, the net is down at 97, 87, and 73. So if you're a believer of parabolic, sit tight. If you're thinking that this thing has had a very, very big move and it has any connection with China or any connection that would be involved with supply chains or anything that could be disrupted with a big angst going on, because China is not roll over and play dead kind of deal. Anyway, so yeah, what would I be thinking up here? I'd be thinking hold if you're thinking of parabolic, or hedge, which would be sell it out of the money call, and the premium's got to be big, this kind of volatility. So you sell the out of the money call, you grab some cash, and then you either buy a put with it underneath to protect your money, or you hold on to it and collect the cash and go enjoy yourself with the cash that you received. If it goes up and hits your strike and you don't like what you see, you think there's a lot more coming, you buy back your call and you roll it up. Okay, any other
And
question?
how about Uber? UBER.
Well, the funny thing about Uber is, they tell me that they lose money on their deliveries, and then they were going to get together with Grubhub, who also loses money on deliveries. So it's that old joke: we lose money on every trade. How do we make money on volume? You know what I mean? Anyway, Uber, another company hasn't been around a long time, so I mean, we don't have a lot of data to work with here. Um, the ride sharing, the unemployment rate was supposed to help Uber a lot because they'd have a ton of drivers. But don't forget, Uber is now fighting states like California with their independent contractor deal. If everyone has to be an employee, that opens up a whole big can of worms for these guys. So let me look on another graph here real quick and see if I can get something that might be more helpful to me. Because this longer term stuff doesn't work on Uber because it hadn't been around very long. Okay, so let's see what I see here on Uber. Okay, yeah, you've got 52-week range is 13 to 47, so you're kind of well off the highs. I got moving averages, 50-day is 27 and 200 days 31. So you're trading above both the 50 and the 200, which is good, but they're inverted to the downside, which is not so great. Short interest is about 2%. So there's not a lot of people short, so you can't count on short covering. This thing, again, peaked out at 47, then it had a high point of 40, and now recently it seems to have had a high point around this 35 area. So I personally would probably be careful on the stock unless it broke 40. If it broke 40, I'd be much more interested because it would open up the concept of 45, 50, and 55. If you can't get above 40, you obviously can't get get to those other numbers. And I wouldn't be interested in $5 on it unless I was some kind of a short-term day trader or something. So anyway, my view on it is unless it gets above 40, I would be concerned about it. But if I did own it now, I'd probably use the 50-day of 27 and the 200 days as 31 as two lines in the sand, and I probably wouldn't let it get much further underneath either of those numbers before I cut and run. So again, the good news is it's above the 50 and the 200 day. Bad news is the 50 and the 200 day are inverted to the downside. So another good thing would be holding above 31 for a period of time so that the 50 can cross back over the 200. And then, of course, I'm a player at that point. Okay,
How
anything else?
about ACB, Aurora Cannabis?
Apple, Charlie, Bobby?
Yeah.
Now, this thing's been wild, I'm sure, because cannabis has been wild. So let's take a look at it. And I don't know how long it's been around, so I got to go to the other screen real quick here and plug in what it's telling me. Yeah, this is another one that's not going to have a lot of history to it, I don't think, right? It's been around only a little bit. But it's been a wild ride. Let's see here. Oh, come on down real quick. Okay, let me just go over here and get the detail on it. And yeah, this stock's been 100 in the last 52 weeks. It's been as low as 5. It's been as high as 102. And now it's at 15. So obviously, if you can get the right side of this thing, it could be, it's got huge short interest. 202% of the stock is short. So, I mean, at any point, it could get rolling. There's the chart a little bit better here for you here. It's been around a list, I guess, for a little bit of a while because you've got a 1 year and a 2 year. So that's 38. I mean, this is a thing that's just oversold. And, you know, if you're gambling and you want to play a reversion trade, you'd have to buy it and then put your stop underneath the low of $5. And you just got to hold your eyes and, you know, hope it goes back up towards these numbers up here because the circumstances change. It's a $1.76 billion company market cap, so it certainly has some money. But again, the good news is it's above the 50-day average. So if you want to have a temporary line in the sand, you could use that. $9.37. So therefore, you know, you don't have to wait all the way till 5:30 to get out if it's going to be a collapse deal. But you know, they do have money. You know, there is some capitalization to it, and the volume is exploding. The 200-day moving average of volume is 4 million shares. It did 12 million today. So people are, you know, getting involved. So again, there could be something to it, but it's a gamble stock, obviously. And so, you know, what are you going to do on a gamble? You got to put some kind of rope on it. Are there options on it? I probably would play it with options. Why would I do that? Because then I know my risk going into it, and then I know I don't have margin call or forced liquidation. And let me just give you another thing here. See if they do have options. And this might be a leap deal. You meaning a long-term option. Let's see how far out you can go. I mean, anything that used to be, the moving averages are up at 60 and 40. So there's plenty of room on the upside if there's a turn to get back to, you know, some level of where the, let's see how far out. You can go out to January of 2022. So that gives you the rest of this year and all of next year. Let's see what that would be. Give you an idea. Okay, let me see here. Will they give me a quote? Yes, they will. Okay. No volume. Yeah, it's no volume. They only have, yeah, it's hard to work with here. On the calls, they'll let you.
Hey, Jim,
Yep.
we're still just seeing the bottom of the chart.
Okay, let me bring it up then. Hold on. I'm on another screen getting some other prices here, but hold on. Are we better? Better?
Oh, yeah. Can you show the what you were looking at with the leaps, or is that?
Well, I'm just giving a ballpark example of if somebody wanted to buy a call on this rather than play for the actual stock, simply because again.
Yeah.
I'll just give you an idea. It looks like there was some trading done on $15 calls today. I don't know how accurate these are, though, so I don't even want to quote them. And anyway, let me just talk about the concept. You look up the prices tomorrow when they're live, because those are the only quotes that would matter. And rather than getting involved in the stock, if you think there's potential of going to 40 or 60, and you want to go into the January of 2022s, which again don't expire till the third Friday of January 2022, gives you the rest of this year and all of next year. And you could go out of the money a little bit because you're thinking there's a big move coming. And then bottom line is you have a bet. And the bet is, let's say you bought a $20 or a $30 call, and this thing goes back to 40, 60 or anything like that. Then obviously you have a limited risk position. Whatever you paid for the option is the limit of your risk. And you've got leverage, because you're only going to buy a fraction of the price of the actual stock, right? That's what the option's all about. And then you sit tight, and if you're right on this thing, you can obviously make some money if there's big volatility. If you're playing the absolute stock here, The only two lines in the sand that make any sense to me would be the $9 and change on the 50-day moving average and the lows of 530. Okay, but and again, who knows with these things? They go back. I mean, the thing's tripled off the bottom. Nothing wrong with that, but it's also lost 85% off the top. So, you're talking about a company that's all over the road. That's why having parameters on something like that would make some sense, meaning some kind of a stop loss hedge, stop loss or some kind of a hedge, or just forget this thing and just do a limited risk call way out in time and just put it as part of your speculative portfolio and leave it alone. And then if it goes nutty, you got that call that is good till January of 2022. And if it doesn't, you're out the premium. Anything else?
How about WYNN, WYNN?
Well, this already had a good jump. You should have gotten to this when it was March and April, because that's when everyone thought no one would make a bet again. They forgot what human nature is all about. It's still going good. And they're supposed to open in June here in Las Vegas. So again, and they're supposed to open up in Macau as well, or maybe they've already opened up in Macau. I have to double check that. But, it is still a rebound trade. As opposed to Microsoft and Google, they already have gone past their rebound into uptrends. This is not in an uptrend, as you can see. The moving averages come in at 109, 119, and 132. So this is just a reversion trade you're involved in that still may have some legs. That 100 number looks like it might be trouble. You see all those lows? So I would be concerned as you got into there. And then above, you're 109, 119, and 132. So the low this month is $70 ballpark. That would be my line in the sand. If it took out 70, I'd say adios to the thing. But if I wanted to bet on WYNN, I would bet that it has a chance to go towards 100 or those moving averages on a best case scenario. If they open up these casinos and everybody starts gambling again and everyone's wearing a mask and, people still are out there trying to have a good time or whatever, it's all according how this restart goes. But right now, people are betting, that it's not going to be as bad as when it went down to $40. But you've got some lines in the sand there. The low of the month of 70 would be a decent one. And then, again, just see if you're fortunate to get this thing to go back towards where these lows are at around 100 or to where those moving averages are above. And it will go to those moving averages if the return is positive. And it may go over up to those moving averages, but take more time to do it. So maybe these moving averages and above is a 2021 deal, whereas 2020 might just be getting back towards sea level here. But again, it is a reversion trade. It's not a brand new bull market in my view. See, when it's in an uptrend back here, you can see that's a bull market. All the averages are under the market. The averages are rising. Okay. So if we got above 140 again, then all these averages reverse back up. Then you've got a chance for all of this stuff up here. But I don't think you have a chance of all this stuff up here as long as it's trading underneath the 120, 140 area. So, 120, 140 to me is a very huge zone here. And yeah, that would be, where right now it looks like the limit is. You get above 140, it opens up the door to everything else. Anything else?
Okay, yeah, let's do one more. WRK, WestRock.
Okay, WestRock. WestRock was up today, and let's see if I can just pull this up here a little bit better. Yeah, again, this company's not been around forever either, huh? Kind of a newer company. And again, it's having a reversion trade. There's things that are above their averages and already gone, right? And that's tech and semis and healthcare, and now the communications and the consumer discretionary. Okay, a lot of those are already back up and into their, the Nikes and the Starbucks and the Home Depots, But this is a reversion trade. So you got the moving averages coming in at 35, 40, and 46. And this thing's trading at 27. It went from 44 down to 22. And so obviously I'd be concerned it could have trouble here at the at the 35 mark. So it could, could have another bounce in it. I'm not that familiar with what they do and how they do it, so I can't give you too much there. Let me just look on another screen to see if I could be helpful a little bit more here on information. Oh, okay. They're a finance. Oh, pharma. Okay. Well, you know how well, no, is this WST?
WRK.
WRK. I'm sorry. Looked up the wrong one. Okay. WRK. Yeah. West Rock. Okay. Yeah. A 44 down to 21, back to 27. Again, a rebound trade here. I'm trying to just look at they got 6 million shares done today. So that sounds pretty good. And let's see what it's been averaging just to give you an idea. Okay, so that double volume. Okay, so this thing obviously has interest coming back into it. And yeah, like I say, if it can get above that 34 number, it would be really, it would set up the stage to go back towards 45. So yeah, this thing has interest coming in. And sometimes when you get a big volume jump like this, you'll have a lower volume pullback. So I would probably take a shorter term graph if I was trying to trade this thing, rather than looking at a 1 year graph or a long term graph. Maybe I'd look at something like a 3-month graph and see if I can get some kind of an idea of where it could be bouncing from and to. And yeah, what I'm getting here is that you could put your stop under 24 at this point, 23 and a half, because that was the recent low. You certainly don't want it going underneath there. So call it 23 bucks on a stop. And then, of course, it looks like there's a gap between 28 and 31 or 30. So it could be going into that gap. And once that gap is filled, if you can't make much progress past 30, then obviously I would be concerned about that as well. But it definitely looks like it's trying to make a turn. It had good volume. It had a breakaway gap today. So let's see if it can keep the steam here and not come back and fill that gap. So it had a breakaway gap here today on great volume. So obviously that's why whoever into it is thinking it may continue. And it looks like it may want to try to definitely fill in that 28 to 30 gap, which is another $3 to the upside. But then the terrain could get a little bit more difficult. So yeah, looks like obviously something's going on there. And the PE ratio is only 8, so you certainly aren't paying very much for the company. And it does yield over almost 3%. So there's a reason people might pick it up for that as well. All right, guys, we could be here all day because there's 5,000 stocks on the Russell. Did you know that? And so we could cover them all, but we can't do it. So I'm going to be wrapping up here and sending it back to David. Again, optionprofessor.com is the website, optionprofessor.com. Also the email. If you have any questions that I haven't been able to cover, and I'm sure you do, shoot the email over to optionprofessor@gmail.com, and I'll try to give you a hand with your question and give you what my opinion and my viewpoint might be, and see if it might be of help in your process. So right now I'm sending it back over to David, and thanks everybody for being here today. Sorry for running a little overtime.
All right, thanks, Jim. Just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast network. You can also go to TimingResearch.com, where I will post the archive for this show as soon as I can get it ready. Also, all the past shows are available on there as well. So I just want to thank Jim, the Option Professor of optionprofessor.com, for being here today. And thanks, everyone.
Thanks, David.